Hey guys, it's super hard to be a landlord and property investor these days. Basically, it's super expensive, high risk, and it takes a long time. These days, the extra mile is not going to cut it. You need to do the extra 10 miles. You need to be obsessive about your goals, and you have to have the right team around you. So today, I've got a very good friend and investment consultant and property coach, Roy Adams, here with me. And we're basically going to talk about what he does, how he helps his clients make an average of $130,000 per deal he finds for them. So this is Roy.
Hello.
Hey Roy, thanks for coming today. So basically this is just a open form kind of conversation that we can have with our viewers. And I had a few questions about what you do. But before that, can you explain in your own words what you do?
Yeah, so we basically help investors achieve their goals. So we look at the goal of where you want to get to. We look at your current position, and then we draft a plan, a strategy for you to get from where you are now to where you want to be. The other thing is we help and support every step of the way, from looking at the property, sourcing finance, doing the due diligence, running the numbers, negotiating, renovating, tenanting, absolutely everything. And every step of the way has to be maximized and optimized to give you the best result at the end.
Yeah, thanks Roy. They say that you need to look for 100 deals before you find the right one. Is that still the case?
Well, I think that you definitely want to look at a large number of properties before you actually make a moving forward to purchase it. Why? Because if you look, let's say, at least 30 properties before you make a decision, then you're actually becoming an area expert, right? Think about Sandringham and let's say 2-bedroom units, right? Then look at all the 2-bedroom units that are selling, follow up on the sale, how much it sold for, visit the property, see what condition it's in, and then you're actually becoming an area expert. So then after you view 30 of those, you look at the next one it is on the market, you will pretty much know very quickly what it might sell for. But obviously looking at the rear view mirror has its limitations. So comparable sales is not everything. You really need to be aware of the property cycle and the big picture, the context.
Yeah, very true. And in terms of the big picture and trying to find that deal amongst 100, maybe even more properties, I imagine with the new legislation coming around, everything is costing more. It must be harder to get the returns that you used to get.
I mean, obviously with the proposed removal of the interest deductibility, that hits investors in cash flow, right? Because let's look at the scenario that you're buying a property with $1 million lending, you're paying 2.5% interest rate, so your interest repayments per year are $25,000, right? Now 33% of that is just over $8,000. So you are getting hit by just over $8,000 a year. So then the question is, all right, what do you do about it? Well, the way that I look at it is I'm trying to look at the worst case scenario and making my strategies win at each and every outcome. So now in my due diligence, I'm taking into consideration that new added tax, and I'm making the number work, including this tax.
Awesome, right. So you're balancing out buying an old property and buying a new property, and you say buying an old property would work if you paid X amount because you've considered the extra costs on the interest of the mortgage.
Yeah, so obviously the purchase price is absolutely critical, because let's assume, right, it's not the law yet, so let's assume that on new builds you can deduct the interest repayments and on existing houses you can't. You need to buy existing house for 33% less than what you would pay for a new build to make the cash flow exactly the same, right? And now it's a really good time to buy because there is confusion in the market, so that creates a window of opportunity. So we're actually looking very hard at finding properties. Now, this is in regards to the purchase price. And then you want to look at strategies to increase the cash flow. So there are many strategies that you can actually significantly increase the cash flow. For example, building another property at the back, splitting a house into flats, adding bedrooms. There's so many things that you can do to mitigate that. And just remember that even if this new tax takes place, in terms of the big picture, it's enough to have a tiny little bit of capital gain to make that new tax negligible. So you know, on a $1 million property, it's enough to have 1% increase in capital gain to offset this new tax.
Right, that is interesting, because one of my other questions I was going to ask you today is, does it make sense in Auckland to be looking for cash flow positive deals? Is there any other way we could justify buying a rental property that you still have to top up after collecting the rent and all other expenses?
Yeah, well, obviously, negatively geared property or strategy has its place, but it's not my favorite. I like cash flow from day one as well as capital gain. The reason being is that if you're buying negatively geared property or one that has minimum cash flow, it hurts your serviceability to get funding when you go and get funding for the next property.
Right. I mean, with rents going up so long, quite quickly annually, I've been a property manager for 10 years, and basically rents have been going up between $20 and $30 a year over that time frame. It won't take too long for anything that's negatively geared to become cash flow positive. So yeah, no, that's great. My other question was around balancing buying a new build and the existing stock. My thoughts around this whole situation where the government is making it more favorable for investors and first home buyers to buy new builds, would then the other side of that coin, wouldn't that make existing stock with bigger sections worth more, because now you're buying a lot more potential? You're buying a property that you can subdivide and build, townhouses on, instead of just one new build on a small section, for example, Hobsonville Point.
Yeah, absolutely. So the government is trying to encourage investment in new builds.
Yeah.
And that's really at the back of the unitary plan that enabled high density buildings. In terms of buying existing versus new builds, it comes down to the numbers at the end, at the bottom. Because if you're paying for a new build top dollar, regardless whether you can deduct or can't deduct the interest rate, your cash flow might be minuscule or maybe even negative. And add to that the fact that you can't actually improve the property or do anything to increase that cash flow because it's brand new, you can't do anything to it, then it might not be the best deal. But at the same time, if you're paying for an existing property too much, and it's again cash flow negative, and let's say that it requires very high maintenance cost, or let's say that there's just no room to add value or to add cash flow, then you're shooting yourself in the foot again. So therefore, I don't think that there is one definite one way is much better than the other. It comes down to the individual deal, and that's what we do. We actually sit with you and we work out exactly what will work best for your personal situation, and then we make it happen.
Perfect. Well, I wish I was a client of yours, because I traded a property, and it was the first one I ever done, and I paid $10,000 too much for the property, and it took longer than I expected to renovate. And when I sold it for $10,000 less than I was hoping. So that $20,000 down the drain would have covered your fees, and you would have helped me get, what's your average equity gain that your clients get? You said there's
132,000.
That would have more than that would have been awesome. So yeah, thanks guys. Actually, one more question. I have a rental property. I have a couple, and they're both on interest only at the moment. Besides from being affordable, do you see any other benefits of being on interest only?
Well, it's the cash flow, because now I get the question as well now, and people asking me, well, Roy, now that we can't deduct the interest component, if that becomes the law, should we shift to P&I? Well, I don't think so, because you see, if you can't deduct the interest rate, the interest payment, it's already hitting you in the cash flow. So why would you transition into P&I and get an even bigger hit on your cash flow?
Right.
Now, as an investor, there are much better ways, much smarter ways to pay off your loan if you wanted to, when you're ready to transition to retirement, than just to pay it off from your own income.
Right.
Because when you pay it off from your own income, it's an expensive money. For every dollar that you pay off, you need to earn $1.30.
Yes.
But let's consider a scenario. Let's say you're buying a property that's worth $500,000. Okay, how do you pay it off quickly? Buy 2 properties, sit on it for 10 years. That's a cycle. All right, property prices double in a cycle, and then you basically buy 2, sit on it for a cycle, sell 1, and you've got the other one for free.
Nice. Yeah.
You know, this is just one of the many ways that you can do it.
That's one of my favorite ones. I'm very patient, and I like to take things slow and work hard.
Yeah, well, you really use the market to pay off your mortgage rather than you paying it off.
Yeah, awesome. All right, thanks, Roy.
Awesome.
I'll leave details where you guys can contact Roy on the bottom of this video, and also on the comments when I share this on Facebook. And my name's Patrick from Good Neighbours Property Management, property manager extraordinaire, and business owner. I'm your man. We are obsessed with what we do. I only like to work with people who are obsessed with what they do because they get things done. If you need your house rented, if you need it fixed, I'll get it done. The same with Roy. He's obsessed with what he does, and I enjoy spending time with him and talking to him about real estate. He has a Sunday property tour where he takes his students and they look at properties and they find good deals, and it's also very educating to, as an investor, to come along and you find, you know, things out about areas of Auckland where you think is awesome, and then you see a property that you think is fantastic, and you find out that it's built on an old rubbish dump and the bricks are all cracking, and you didn't know that before. So anyway, yeah, come along. I'll share Roy's details. You've got my details. Take care. You guys have a great weekend.
Have a great weekend.
Bye.